Wow, what a day. The global markets just gave us an absolute masterclass in whiplash. We started today, March 9th, with pure, unadulterated panic, which then turned into one of the most incredible reversals we've seen in a long time. But the real story isn't just the reversal. It's about who bounced back and who got left in the dust. So let's get into it. What on earth just happened today? Okay, let's just look at the scoreboard because it tells the whole story. On one side, you've got the U.S. markets, which came roaring back from the dead. The Nasdaq 100 up over 1.3%. And the Philadelphia Semiconductor Index, the SOX, it just skyrocketed, closing up almost 4%. But then you look at the rest of the world. The Kospi in South Korea got hammered, down nearly 6%. The DAX in Germany, the FTSE in London, all finished in the red. It's like we were watching two completely different worlds today. And our job is to figure out why. So here's how we're going to break it all down. First, we'll look at today's insane market whiplash. Then we'll zero in on the exact geopolitical moment that flipped the entire script. After that, we'll dive into why the US was so resilient while the rest of the world was so fragile. And then we'll look at what the data tells us is coming next and wrap up with a solid framework for how to think about all this volatility. All right, let's get right into it. Part 1. Today's market whiplash. We've seen the scoreboard. We know there was a massive split. Now we need to understand the event that literally cracked the global market in two. And that brings us to the pivot points. This wasn't a slow-moving storm. This was a lightning strike. The entire day, everything we saw, it all hinged on one single moment. A moment where a story and narrative became more powerful than anything else. So here's how the chaos started. Early this morning, the news hit. Iran had closed the Strait of Hormuz. Now, for anyone who doesn't follow this stuff obsessively, that's a huge deal. It's a choke point for about 20% of the world's oil. As you'd expect, Brent crude prices shot up, heading toward $120 a barrel. And that just triggered this wave of panic, a massive global sell-off as everyone started screaming stagflation. And this is where it gets really interesting, because to understand what happened next, you have to appreciate this idea, inspired by the legendary George Soros. The core of it is that markets aren't just a mirror reflecting reality. What we believe, what we fear, what we hope for, that can actually reach out and change reality itself. And today, we saw that theory come to life. So the key concept here is reflexivity. That morning panic, that was a classic negative feedback loop. News caused fear, fear caused selling, which caused more fear. But then the intervention came. A presidential announcement hit the wires, saying the conflict could be over soon and that the U.S. would secure the strait. Now, that statement didn't just report on the facts, it actively changed them. It shattered that negative loop and started a new, incredibly powerful positive one. But, and this is the important part, it only really worked for the markets that were ready to believe the story. And this is the moment where our story forks, right? Because that wave of good news, that positive feedback loop, it didn't lift every boat. Which brings us to the million-dollar question. Why did the U.S. bounce back so hard, while Europe and Asia were left struggling? Well, this slide really lays it all out. It's like we're looking at two different economic engines. In the U.S., you've got this massive tailwind from the AI supercycle. Think NVIDIA and companies like it. The U.S. market is just built to be flexible, to pivot on a dime based on a new narrative. But then you look at Europe and Asia. They are so much more dependent on imported energy. Their institutions are more rigid. For them, the fear of sky-high oil prices isn't some abstract concept. It's an immediate threat to their entire manufacturing base. And if you want to see what that fragility looks like in cold, hard numbers, here it is. The South Korean Kospi crashed almost 6%. That wiped out $350 billion in value in a single day. Why? Because South Korea imports over 70% of its oil from the Middle East. For them, this threat was real and it was immediate. The market didn't wait. It instantly repriced huge companies like Samsung because they couldn't just wish away the new energy reality. So we've unpacked the what and the why of today. Now let's pull out the data and see what the models are telling us might happen next. We're moving from explaining the past to forecasting the aftershocks. Okay, so what you're looking at here are the results of thousands of what are called Monte Carlo simulations. Think of it like a supercomputer running thousands of possible futures to see which ones are most likely. It doesn't give us one answer, it gives us probabilities. Our base case at 52% is that things calm down and both the S&P and Kospi recover nicely. But look at that bear case. If the closure drags on, the models say the KOSPI gets hit almost twice as hard as the S&P. That's that underlying vulnerability we were just talking about, showing up in the data. And here are the specific forecasts our models spit out looking ahead to the end of March. You can see that divergence is expected to stick around. The models are predicting U.S. tech is going to keep leading the charge. The SOX index could add another 8.8%. But at the same time, major indexes in Germany and Hong Kong are projected to keep sliding, still weighed down by those bigger structural problems. So, given this really complicated and divided outlook, what do you do? Well, for our last section, we want to share a structured way of thinking about this market. We call it the reflexive alpha framework, and it's built specifically for the kind of environment we're in right now. Now, this framework is just one way to structure your thinking, and it has three main parts. The first idea is a hedged semiconductor play. The logic here could be to focus on the U.S. leaders of the AI revolution while also acknowledging the serious headwinds for their energy-dependent counterparts in Asia. Second is an energy and volatility pivot. This might involve using something like gold as a read on the market's fear level, while also having a view on oil based on that de-escalation story. And third, a position on credit. It's a classic idea. In times of high stress, short-term U.S. Treasuries are often seen as a place to seek relative safety. And all of this brings us to the one big final question that really sums up everything we saw on March 9th. On a day that began with a clear, numbers-driven shock to the system, the final outcome was really decided by a change in the story. It really makes you wonder, in this hyper-connected, high-speed market we live in, is the narrative we tell ourselves now even more powerful than the numbers on the page? Something to think about. Thanks for joining us.